Howdy my friends, nice to see you again. I want to share some thoughts with you. This time, remember you can always look up more details on optioncrusader.com and my blog. And here we go. Alright, today I want to show you the technical details about how to upload the data from Yahoo and how to run a few formulas on it. If you will follow me, you will be able to reproduce this. You have to dig a little bit into Excel. Don't be lazy, don't be a gold digger, you have to put your efforts in. Alright, let's see what we get now. So what we collect is this data, date to volume, the ticker symbol. I put everything in here already. That brings us right to the page. Then we go to historical data. We put in 5 years, and instead of the daily we put in weekly. We apply this whole thing, download, and when it's done we double click it to open it, and here you have it. We copy everything, Control Shift down, Control C for copying. Going back to our site, right click, and we only put in data, nothing else, no formulas. No formulas, but no format, nothing. You will see this one here changes. Alright, I run this already through before, so you might not see so many changes right now. After this we create these fields here, because they will give us the average return or the average movement of the underlying, and this is our worst case scenario. It moves up 2% per week. If there's no downturn, nothing else, it just goes up, and this is what it goes down. Same thing, it's pretty close, right? But the only difference is it goes more weeks up than it goes weeks down, and that's why you might make some money on this stock. So yeah, 53% of the weeks are going up, 46% down, and this is the mean average moving up and mean average moving down of that stock. This number incorporates the percentage of the weeks it's actually in place. So average return times 53%. So this is what you would expect any given week in any given month as a return on this underlying. You can do this with any stock you want. I'm just introducing you to a method I'm using, that's it. So the downturn is only 46%, and it's a little bit smaller here. Then you come up with this number. Remember what I told you in the videos before, that this is almost going up 100, and this is going up 110, but on the downside it's also almost going up 100 compared to the SPY and the DIA, for example. The Qs, they were going up 1.1 and 0.65, if you remember, right? So this is how I retrieve those data. So then we go to returns. We filter them by numbers, everything greater than 0. This is our positive returns. We have 139 counts for this, so we put this number in here. Then we have this number here, we copy this one and paste just the value. Then we go to returns, numbers less than 0, and then we get this number here. We copy this one, put this here in the bottom, and you'll see this change. So the count is 121. We put this number in here, then we clear the filter. We make sure that we have our 262. This is the count when you count this whole column here, and this is the count from what we have worked out. Here I have a little, there are 2 weeks in a year that has 00. It must be doji weeks, kind of, you know. So you have to put this number in here too, but you will be able to accommodate for that. So that's the swing. Remember that I said the swing up and down is 2% of the stock, upside to downside in an average week. In the worst case scenario, we can make this one here like this plus this, and this here we take times -1, and this we convert into percentages and run it over to the right side. So this is our worst case scenario range. Alright, that's how you can do your numbers. They all come automatically, okay? So after we have this one here, later those numbers, you see the median return or up move, 1 week, 2 weeks, 3 weeks, they are used for this one here, because you take the current stock price and then you multiply it with the percentage of the median return, which is this one here, right? Because it's compounded, and this here is times 3 weeks. Everything is based on weeks here, so right. So this is the worst case scenario with a swing of 4%. So you will end up at 244 instead of 235 after 4 weeks. Average, that's the statistics, okay? So that's my worst case scenario. So I will keep this in mind later for the standard deviation, okay? I will place actually my trade a little bit lower, in between, just depends on the money. Okay, next step is this column over here. This will give me the standard deviations. That's the mean, the standard deviation. Alright, so I will calculate all those numbers here, and those numbers, they show up here again, okay? For my next data set, this is what I need. So the standard deviation, how to create them, you go to data, you get data analysis, you go to descriptive statistics, you put your input column, which is the return we created. Make sure that you start from H7 in my case, and you have 262 data points, which I have 262 minus 6 ahead of it, right? So the output data range, you have to make sure that you click this field, otherwise you will change this one up here. Where will it be? So we just put this one in because the computer will fill this all out. And then we click summary statistics, and that's it. And it will warn you, alright. And you see it changed a little bit. I did this already before, that's why you will not see lots of changes. So this changed all those numbers here. And then we go over to this. Now I have the interval sitting here. That's a new input for the next data. Now we create a histogram. We go to the histogram, create these ones here, put the input range again. It's the return all the way down. Then we create the output range. Which will be the bin, but we have the bin range, what they're actually trying, what the program or the statistics actually looking for, sorting out, and they sort everything out that falls within the deviations. Alright, within the deviations we will get how many weeks it falls within the deviation, right? How many gains and losses this are, how much the probability is, and this is a cumulative percentage that we know that our data are correct. We just add them all up and we should come out with 100%. This number down here shows you that we have 262 data points or weeks, and that's pretty much it. So it will warn us again, and you will see the they change or not. Bing, there you go. We just format this over. I always put the new date in here so that I know when I changed this last time. So that's it. Now we have our histogram. Here we also have, I put the meaning in here so that it is easier to read for people, including myself. I added 0 as a mean level because this is easier for my eyes. Otherwise the data will look a little bit crooked. But anyways. But let's go here to the weekly distribution, the histogram. Alright, and that's pretty much what we got. So now we have our frequencies in here, how often that occurs, then our probabilities, ding 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 ding. So for example, to get hit up here in a 2.5 standard deviation, you have to add all those numbers. You have to add all those numbers here, because you will get hit, and you will get hit for this one too, because they will fall even further. So it's 1.1 plus 0.8 is 1.9, 2.3%. Alright, to be hit on a per statistics on this 2.5 deviation. Keep this in mind for now, and I will show you this on another table here. So this is how the curve looks like. As I said before, these two twin towers, the towers of truth, they are not that far away. So this is a pretty much range trading ETF. Great for my purpose, I love it. So you go up and you see most of the data, they fall within this column and this column here, right? So when you go down here, you have 36% and 42%. This is 78%, almost 79%. So almost 80% of the data, they fall in here. You can take this data too. Then you have 80%, 88%, 93%. So 93% of all data, they fall within the first 2 standard deviation, up or down. All right. So if you stay a little bit out here, you see you have very little to lose, and it's a number game. Most of the time it will stay here, and sometimes you get hit, and that's just normal. Okay, then these numbers here, what does it say? 0.26. Okay, these are the numbers here. So I already said this is the median growth of the stock going up, worst case scenario. I have the same thing for the downside, for the put credit spreads. That's how it usually goes down. Worst case scenario going down. Alright. It also shows me the first standard deviation, short call, first standard deviation is K13. Right. I get these numbers from here. Alright, first standard deviation, take this number, right? It's all interconnected here. You go out here, the second standard deviation, go out here, third, you see, and this is just the same plus 10. But plus 10 is only in this case, it usually represents 1 standard deviation, not exactly, but that's what I take. Okay, I just stay $10 away. The trigger rate here, as I said before, if you stay in the first standard deviation, if you get run over, it will be the first standard deviation, the second, the 2.5, third, 4, and so on. All of them will run over you, so this is the highest probability of being hit, which is 53%. Then you go further up, it's 10% only, and I said this is 2% at 2.5 standard deviation, right? 2.5 takes us 3 to 4 to 5, and take this all into account, and you come up to this number, right?
So there you have it.
But there's a second standard deviation. This is pretty much how I calculate this. Now I have 242, and here I have these numbers a little bit diverging. I would stay above the 235, maybe 236, 237, even 238, but you have to see how the price is going. You want to have 10% for the collateral you put in. That's my number. You can make 5%, doesn't matter. But my number is $900 per contract. I want to have a $90 credit. So if you go with 2 contracts, that's then $1,800. You want to have 180. 4 contracts is $360 and $3,600 collateral, whatever you think. All right. So then the
discrepancy in the gain of the underlying between ETF.com and
the whole equation is also depending. This here is also depending on the ETF.com. So you can put this one in. It's already all programmed. And then we go down here. Since we run everything on a 5-year term, so we see nicely how range trading this is. I love it. And then we have the IWM 5 years period, 1414. Okay, this is the return you get on a 5-year base, and you see in 1 year it made 36, so more than double this one. This was pretty. But this is what I'm saying. This is an extraordinary bull market in the past year and a half. There will be a big crash coming. Not get burned or take precaution. I don't know. All right, here we have 1414. So I put this in here just to show you. Let's see this 20, and it will change something down here because I also have the Black-Scholes formula for call options and how much return they're actually generating you. And what I have here is this sheet generates a certain gain per year. Then I look up the experts. They say it's only this one. This sheet is like this one. So I take the average out of it. So it's 31%. But we saw that in the last year it was 36% on their sheet. And in 5 years they have 14%. Well, I just averaged this to get an average price of the call options. Just a quick go over this one here. Don't touch anything in the green field. Today's price, you put your today's price in, and this will all change. Entry price, stock dividends, there's nothing. Then you have to go get the 10 years bond rate. You can always look this up. Let's just take a quick look to this, how the bond rate is. It's a 10-year treasury note, which is actually not a bond. Just takes a 10-year treasury yield. 10-year treasury yield, there you have it. That's the number, okay, barchart.com. You can find it on many websites. You put this one in here because when you change it, the option price changes. Date to expiration 1 year. You will cash it in 10 days before the end. How many contracts? 1 contract. So the price should be $23 per contract. So it makes $2,300. You have your strike price, $225. So this should be your return in 1 year if you just keep it.
this will be another story.
I will write something about it, how to do calendar spreads, but that's not today. Today is just the bear call credit spread. All right. Then I have these columns here just to illustrate the lines in my charts. This here is a 10 months weekly chart. This is all the prices we actually got from IWM, and these are all the adjusted closing prices. You downloaded this from Yahoo. These are the calculated standard deviations, and this is the current price. And this is all those data here. If you get current prices R43, which is the price you put in here daily, okay? And then you just write columns. It's just like the one before, this one is like the one before, so you just have a column. What it does, it makes lines. So this is our 2.5 standard deviation, this is 3.5 standard deviation, and this is actually the price of the IWM on a weekly basis. So this is only changing data. These are just the lines. This is the current price right now. Standard 2.5 standard deviation below, 3.5 standard deviation below. So you stay within the range and you have your data, and that's it. That's how nice it looks afterwards. So what else I can tell you here?
The entry.
Yeah, this one will be my entry point, and we can take a look how it looks today, because we have already Monday. Yesterday we had a green candle, or I write them blue. So I need to have 2 blue candles, and then I will calculate the price on the deviation. The only thing what I do right now, after I set this all up, I save it, and then I will only change the price. Alright, only change the price, and the price I change down here, and then I just have to confirm it up here, and that will the price change will change the standard deviation, right? But the statistical values I gathered from the past 5 years. So there's a very minuscule change in whatever you do here. You don't have to change all the data every day, every week. I do it once a month, every 2 weeks or something. It only takes me 5 minutes.
This is all for today, my friends. The topic will be continued next time.